Hello Sector Watchers, welcome to the show. This is the 52nd episode of Sector Spotlight on Tuesday the 20th of October and recorded on the 19th. I am Julius de Kempenaer and your host for today's show as usual. If you'd like to get in touch, please do not hesitate. My mailbox is open for questions and suggestions, and the comment section below articles and videos is a good place to share your thoughts with me and the rest of the world, of course. Your feedback and your questions are appreciated. I'm always on the lookout for new ideas that I can potentially cover in an upcoming episode of Sector Spotlight. So please don't be shy. As the market just closed, I realized that it is actually the anniversary of Black Monday, the 19th of October, and it's a Monday again this year. For what it's worth, the S&P just closed down 1.6%, but that's nowhere near the declines that we saw in 1987. And also from a technical point of view, I believe the market is in a completely different state than it was back in 1987. We'll start this show with the usual look back at last week's asset class and sector performances and their rotations on RRG. After the break, I will work my way down the investment pyramid, updating my views on asset classes and stock sectors using the rotations on the weekly RRGs. So let's get started. Last week's performance, if we start with the asset classes on the left side of the screen, we will see that the US dollar had a pretty good week, gaining 0.7%, and so did corporate bonds and treasuries, which both gained 0.3%. Versus the balanced index fund that we use as a benchmark for the asset allocation universe, which gained 0.2%. With bonds outperforming the benchmark, it almost always means that stocks have underperformed, and they did so last week, only marginally with a 0.1%, 10 basis points gain. So both stocks and bonds, we're very close to the performance of the balanced index portfolio, which is a 60% stock, 40% bond related portfolio. Commodities, the GSG index was flat, and its DJP, the Bloomberg Commodity Index, lost 10 basis points, so they were basically in line with each other. And corporate bonds were pretty weak with a loss of 40 basis points, and the biggest loss for last week in terms of asset classes was real estate with minus 2.6%. If we look at the various tails, then we can see interesting positive tails and rotations for commodities. These are on the daily. And the longer term picture for commodities, it's getting a little bit vaguer. It's not as bad as it used to be, but it's not very strong either. We're going to look at it later on when we update the big investment pyramid with all the colored blocks. Real estate clearly rolling over. It was in the leading quadrant when we spoke last week. So if we scroll back 5 periods, let me select this chart, 1, 2, 3, 4, 5. This is where we started. This is where we ended Friday the 9th, and then this is Monday, Tuesday, Wednesday, Thursday, Friday. So this is the rotation that we had over the last week. And we see that the stock index, the S&P total stock market index, continued to move to the right, which is in general a relative uptrend versus VBINX. And obviously the government counterpart, this one here, continued to move to the left. We go back to the 9th. So this is Friday, and then we have Monday, Tuesday, Wednesday, Thursday, Friday. So generally, despite, and this is a good example, by the way, of in this case, it's an asset class, so GOVT, gaining 0.3% while it is inside the lagging quadrant. So, you know, these absolute performance numbers are not necessarily related to the relative trend that is shown on the RRG. So Even on this daily rotational picture, clearly still a preference for stocks over bonds. Nice improvement for commodities and a renewed weakness for the real estate sector. If we move over to the sectors, then and this is sorted already, so this is ending Friday. We see clearly a very strong move for energy, but as you can see, it is still down 1.9% over these 5 trading days. Relatively, it improved a little bit, but we know the rotation of the energy sector by now. It's sort of completely detached from the rest of the universe. As you can see, it's tucked away far to the left. This jump in momentum, jump in relative momentum, is still too far to the left to actually be seen as any serious improvement, especially if you take into account the longer term development of these rotations. If we quickly move through these sectors, we see industrials, which it's hard to see with the yellow, but 1, 2, 3, 4, 5. This is where we were week before. 1, 2, 3, 4, 5. So this is last Friday. So we see this improvement of the industrials over the last week, still inside weakening but curling up, so that's a positive. It was the strongest sector of the week, followed by utilities, which was actually moving from leading into weakening. But as you can see, in terms of the JDK RS ratio, utilities is still the strongest sector. It's the highest reading on the horizontal axis. Good old technology, still going strong. Very short tail, as you know. That means that it's a stable trend, and this was another stable week for technology, gaining 0.8%. If we go back 1, 2, 3, 4, 5, then we saw some weakness going into this week, and then it stabilized 3, 4, 5 during the rest of the week, picking up 80 basis points. Communication services continued to weaken a little bit. It's inside the lagging quadrant, picked up on the momentum scale, 1, 2, 3, 4, 5. So we dived into that lagging quadrant, and then this week, 1, 2, 3, 4, 5, we sort of stabilized in that relative downtrend versus SPY. If we move to consumer staples, as of last week, 1, 2, 3, 4, 5, we rapidly moved through weakening into the lagging quadrant, 1, 2, 3, 4, 5, and we see the relative improvement quite rapidly after staples moved into the lagging quadrant, starting to pick up on the momentum scale, while it was still relatively close to the 100 reading on the RS ratio axis. Quickly move to healthcare. By the way, all these sectors, you see these absolute performances. We're looking at healthcare at minus 2.6% last week, and it is still outperforming SPY, which lost 3% last week. So here, the healthcare sector over the last 5 days, through weakening, moving into the lagging quadrant, and then we have consumer discretionary, which moved from leading. I think it was in leading 1, 2, 3, 4, 5. Yeah, it was just in leading, about to cross over into weakening as of that Friday, and then this week we actually moved clearly into the weakening quadrant. And then we have materials, similar to staples, which was crossing over into lagging but rapidly picking up, and the materials sector seems to be following a similar pattern. So it's going through a period of weakness, picking up momentum again. We'll have to see how that follows through. And then we have healthcare. We already talked about that. And then financials continues to I don't know, they basically disappoint, I guess. If you look at the rotation, you see that it improved. This is Friday 9. It looked very nice. From lagging, moving into improving, and then we had last week, which was 1, 2, 3, 4, 5. As of last Friday, financials crossed back into the lagging quadrant without completing a rotation to leading. So financials still disappointing, at least on that daily scale, and I can already give you a spoiler alert. It's the same on the weekly scale. Energy, we talked about that, very rapidly moving up, but still an underperformer. As a matter of fact, pretty strong underperformer versus SPY. So another good example that the relative performance doesn't necessarily have to match immediately and completely with the absolute percentage change that we see in the last column in the table. And then real estate, just like we saw it on the asset allocation RRG, a weak rotation for V and Q. We see a weak rotation for XLRE, and it was actually the weakest sector among these 11 sectors of the S&P 500 last week, with a loss of 2.2%. I want to quickly go to a short break, and after the break we're gonna work our way through the longer term picture using our investment pyramid, working our way down from the various asset classes, yield curve, commodities, sectors, all levels, and talk about that. As promised, I want to spend the second half of the show working our way down the investment pyramid, because it's been a while since we looked at this. I think the last update that we did was in August already, so we didn't do anything in September. The last one was late August, and I'll walk you through my views as of now and what has changed since the last time that we looked at this chart. I'm not going to do all the charts because that would take up way too much time, but I'll just pick out the more interesting rotations and positions. Real estate was and remains, by the way, there are no changes on my views on asset classes. So real estate remains a negative, government bonds remains a negative, govt are way to the left. Real estate had a weak week last week, and as you can see, the weekly tail has already started to roll over, so that remains an underperformer. High yield bonds are on the left, they're short tail, stable, weak relative trend versus VBINX. Stocks and bonds, we're going to look at that a little bit later on, more in depth. The US dollar index remains a negative, remains an underperformer despite the strong week that we saw last week. And I think the most obvious discrepancies maybe is commodities for GSG and DJP, because they are moving into the leading quadrant, although they are starting to roll over and losing relative momentum right away. The reason that I still don't like commodities that much is because of what I see on the chart itself. You can see the improvement. This is DJP. You can see the improvement, so they're inside leading, but the RS momentum line has already rolled over. That's causing that rotation down towards the weakening quadrant. And this longer term trend in relative strength versus VBINX, still not very good. I mean, this is sort of sideways that has caused that pickup in momentum. But I do think that we really need to see a lot more improvement before this will become a really interesting asset class. What might do that is if we break above this resistance level. For the time being, I'm going to look at this as a strong resistance level because we broke it, we fell, and now we are rallying, and that old support level acted as resistance in August, and it's doing it again. And if you look at the chart of GSG
or $GNX, which is the index that belongs to GSG, you see a similar pattern. You break support, and we're now rallying back to that old support, now resistance level. So we're in that range. Here also, that relative strength line doesn't look very strong, doesn't look very good, and we're already losing that relative momentum. So until one or both of these commodity indexes break above that old support level, which is now acting as resistance, I'm going to stick with a negative view for commodities as a whole, as the group. Now, back to our stock-bond relationship, because I think that is the most important thing that we can learn from this overview, from this level. This is the highest level in this pyramid. Stocks, ITOT, still on the right, but losing momentum and rolling over, while government bonds is picking up momentum and curling back up. So that suggests an improvement of government bonds over stocks. And for the short term, that might be the case. Well, it probably is the case. And we need to look at the short-term chart of SPY, which I had loaded up, but now I need to, here it is, SPY Daily. This is the daily chart of SPY. Now, I don't look, especially not when I do Sector Spotlight and take a look at a little bit longer term views. I usually don't look at dailies, but I think this one is interesting because that was the reason why I had that long-term chart up. Now I remember again. This is the long-term chart. We are breaking to new all-time highs. So first this 320.22 was an important level. Then we had the 334, 338, which was a very important level. We broke above both. We fell back. 320 held, and we're now, back above that all-time high. We're still trading above that previous all-time high level that we set back in February. If we quickly make this a monthly chart, it's quieter and it's even more clear. We broke above that high, and we're still in this cluster of monthly ranges, and you can see that little notch here. That's the last close. We're still above that level. So from a longer term perspective, that trend is still there. What I don't like, or what's dangerous, or what's holding back right now, is this massive overhead resistance that we see in terms of relative strength. We've been pushing against this upper boundary of resistance in the RS line for a number of times already. So that's early 2018, Q3 2018, and then around the transition 2019 to 2020. We tried it just shy in August, and we're on our way back up, and you see the RRG lines already rolling over. That's causing that move in that tail back down. So that's now reinforced by that short-term weakness. We see again a test of that, let's round it off at 355 level for SPY. So maybe this is setting up for a new break, higher. I'm not sure yet, but I'm watching this relationship like a hawk, because what I see is that we saw that situation in SPY pushing against that upper boundary, that heavy resistance in relative strength. If we look at GOVT, we see something opposite. Relative strength is pushing against a major support level, and we see some improvement here because we're bouncing off that support level. Relative momentum is picking up. It looks like we're putting in a low in RS ratio, but we're at very low levels. If you look at the chart here, we're having trouble breaking above that high around 28.30 in GOVT. So this could become a major double top, and that will push yields up and bond prices down. We're not there yet, but it's something that I've got in the back of my mind. More importantly, if this relative strength line breaks below these previous lows, and if and let's take a look at SPY, breaks above this major resistance in relative strength, you got two important breaks, and that could cause an explosive situation, an explosive move in favor of stocks over bonds. Now, there's no way you can tell that it is going to happen. There's no way you can predict it, but we can watch it, and because it is such a long-term and important level, when it happens, I believe that there will be plenty of time to adjust your positions in favor of stocks if you haven't already done so, because on the RRG, stocks are still way to the right and bonds are still way to the left. I do think that we see some short-term weakness, and again, I mean, I have penciled in very shallow red lines here. This could become something like a flag, where we break out and then we push it above 355. So for now, I'm watching 355, 357.3 at the extreme as a breakout level for SPY that we need to take out to move higher. And then I'm gonna expect actually for SPY to move higher, bonds to move lower, breaks relative support, and stocks break relative resistance, and get this, this spring that's now being put on attention to let go and let loose in favor of stocks. Short term, a little bit weakness, maybe setting up for this move. Watch these resistance levels in relative strength for SPY. Watch the support level in relative strength for government bonds, because if it happens, these levels are so important. I think that move could be really, really strong. Okay, let's quickly move on to the second level in our pyramid. We have the yield curve, the international markets, and the various commodity sub-indexes. Again, can't look at all these charts, but we can look at the chart for bond maturities. The keen observer may have known that I've added a new group. So the US bond maturities is the RRG that shows the ETFs, so the bond prices, and I've added actually the yield curve. It was a suggestion of one of the users, and I actually followed that, and I think it makes total sense. So the US yield curve, here are the various yields. So this is in terms of yields, and the other one is in terms of bond prices. Now what you see here, and what we've seen happening previously, and I've shown you that chart a few times, that we see a steepening of the yield curve, and that is ongoing. When this little gray line is moving up, the 10-2 yield curve, so the difference between 10-year and 2-year yields, is starting to move up, and that trend is getting stronger and stronger, and we see that happening on the RRG as well. So here's the RRG. These are the longer term maturities. Here's IEF, which is 10 years. TLH, which is 10 and 20, and TLT, which is more than 20 years. And these are the shorter term maturities. They're moving to the right. Longer term are moving to the left. Again, a little short term hiccup, but the big trend is what we see on the yield curve chart. The yield curve chart here, with the difference between 10 and 2, is unmistakably moving to a further steepening of the curve, which means lower short-term yields and higher long-term yields, which gives you a steeper curve and a clear risk of higher yields with bond prices coming off their highs. So that makes me basically swap to a preference for the shorter term maturities on the yield curve, because I see a risk of rising yields, falling prices on the longer term maturities, which represents higher yields. If we go to the commodity RRG, and we have that here, and this is the GSCI groups that we're now tracking. we can see that energy, which is JX here, is rapidly rolling over and moving towards the lagging quadrant. So that's going to be an underperformer for me. We've got agriculture, which is way up inside the improving quadrant and starting to improve. That came from an underperforming. It's now going to be probably one of the stronger sub-indexes inside commodities. Then we have industrial metals, and they're here. They're crossing through the center of the chart, going straight into the leading quadrant. They are looking to be a strong group inside commodities. They came from a neutral view, so I'm going to stick with that. And then we have livestock. That I'm actually going to remain bearish on, because I don't think that this is going to make it. That had to do with the price chart. Again, I don't have time to go over these price charts, but I'm going to remain on an underperformance for livestock, and a similar thing for precious metals. Let's quickly move to the international RRG, so put the US markets into an international perspective, and we then see that S&P, the SPX, is very close to the benchmark, which is the Dow Jones Global Index. Very short tail, so it's slightly outperforming, but very close to the global market index. I remain at an outperform as a preference for US stocks in the international field. And then finally, we move over to the various sectors. We talked about them at the start, and here is the longer term image, the longer term tails. And let's quickly move over them because we're running towards the end already. Sort on symbols. Materials on the right hand side, it was green, it remains green. It's still a strong sector moving higher. And then we got communication services. That was an outperformer. It's now rolling over, and we are seeing some more weakness coming in to the sector as such. It's almost crossing over into the lagging quadrant, so I'm going to take a little bit of an advantage here. I'm going to move it from an outperformer to an underperformer. I don't think that communication services stocks will give us a lot of pleasure in coming weeks. And then we have our weak sectors with energy, which is still there. Financials, we talked about it, rolling over inside, improving, so we're going to be careful with that. And then we have industrials. It is a neutral. I'm going to remain neutral because of the price chart of industrials, which is pushing against resistance, and it will be difficult to move higher. If it moves higher and starts to pick up relative momentum again, industrials could be an interesting sector. For the time being, I'm going to remain cautious. Technology, inside weakening here, but we've seen the chart. That relative trend is still just going higher, very, very stable. So technology remains on an outperformer. We're going to have staples pushing higher. We moved it from underperformance to neutral. It's not there yet, but it's picking up. And then we have real estate being very, very weak. We got utilities picking up steam. Not enough yet for a real outperformance call, but it's getting there. We're getting better. We're having healthcare remains weak despite the pickup of relative momentum inside the lagging quadrant. It remains one of the weaker sectors, especially if you look at the price chart. And finally, we have consumer discretionary, which remains on the right-hand side as one of the stronger sectors. That was it for this week. I thank you very much for watching. I hope you enjoyed the show. Sector Spotlight airs every Tuesday from 10:30 to 11 a.m. Eastern. If you like it, give us a thumbs up, and I hope to see you again next week.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're going to bring you daily content from an incredible collection of technical analysts and financial experts.